Every few weeks, one stock becomes the main topic everywhere. The price is moving quickly, social media is full of predictions, and people start feeling they might gonna miss the biggest opportunity in the history of stock market. Sometimes the company behind that excitement is actually a strong business. For example, Nvidia, its growth has been supported by real demand for AI computing, real revenue and real profit. But even when the company is strong, that does not automatically mean the stock is attractive at every price. That is where many beginners they make mistake. They study the excitement, but they do not study the business. So in this video, I'll show you three important areas I check before going deeper into any stock, and that is valuation, financial strength, and profitable growth. So these three checks can quickly show whether a company deserves more research or not. So to understand this, you do not need a financial degree. You also do not need to memorize 50 different ratios. We are going to use real companies, real financial results, and simple explanation. And if you look at the stockschool.com, you'll be able to find all these ratios in a very simplified manner. And one important point before we begin, these metrics are filtered. These are not buy or sell signals. So a company can pass all these metrics, but still they might have serious risks. So a company can look weak or in one metric for a valid reason. So our goal is not to make a fast decision. Our goal is to ask better questions. So before we look at any metrics, we need to change the way we think about a stock. When we buy a stock, we are not buying a ticker or a symbol. We are buying a small ownership or a small position in that real business. So if we buy a Microsoft share, we are becoming a very small owner of that company. That means your money goes to Microsoft 365, Azure, LinkedIn, Windows gaming, all the other services which they do. So if we buy Costco, we are becoming a small owner of warehouses, products, sales, and membership business. So the real question is not only will this price go up? The better question is this financially a strong business, and does the current price give me a reasonable chance of earning an acceptable return? So three checks in this video will help us answer three parts of this question. Valuation, how much am I paying for that? Financial strength, can the company handle a bad phase? For example, COVID. Profitable growth, is the business becoming larger and more valuable over time? So starting with the first check, that is valuation. One of the most common valuation metric is the price to earning ratio, or people call it PE ratio. So in simple words, it tells us how much investors are paying for every dollar of company's annual earnings. If a company earns $5 per share and the stock trades at $100, the PE ratio is 20. So investors are paying $20 for every $1 of annual earning. But here is the part that beginners need to understand. A low PE does not automatically mean a stock is cheap, and a high PE does not automatically mean it is a bad company. A high quality company may deserve a higher valuation because its revenue, profit, and cash flow are growing quickly. A company with declining sales or serious debt problems may look cheap because investors expect the business to become weaker. A real historical example is Cisco. So during the dot-com period, Cisco was not a fake company. It sold important networking equipment and helped build the internet. The business was growing rapidly, but the stock price eventually reflected extremely high expectation. So when those expectations came down, investors expected a major decline, even though Cisco remained a real and profitable company. So the lesson is not every high valuation technology company will repeat Cisco's history. The lesson is that every great business can still produce a poor investment when the starting price assumption almost perfect growth. So how should a beginner use the PE ratio? First, compare the company with its own history. Is the market currently paying more for each dollar of earning than it normally has? Second, compare it with similar businesses. Comparing Microsoft with a slow growing utility company will not tell you so much. Compare companies that have similar business model, margins, growth rate, and risk. Third, connect valuation with growth. So if investors are paying a very high multiple with revenue and earning growth would be required to justify it. Fourth, remember that PE does not work well for every company. A business with negative earning will not have a meaningful PE, right? A cyclic company may have unusually high profits near the top of its cycle, which can make the PE ratio look very artificially low. That is why I do not use one ratio as the full valuation answer. I also look at forward PE, free cash flow yield, historical valuation, and peer comparison. So on the stockschool.com, you would be able to see all these metrics side by side, and that will help you to get educated and decide better before you invest in any stock. The second check is financial strength. So the original version of this lesson used to be the debt to equity ratio. That ratio can be useful, but it can also become misleading. Share repurchases, accounting rules, and the type of industry can significantly change shareholder equity. So for a beginner, I prefer a more practical starting point. How much debt does the company have right now? And how much cash and short-term investment does it have? How much operating cash flow does it generate? And can it comfortably pay its interest and upcoming obligations? So let's use Microsoft as an example. In the last year of 2025, Microsoft reported approximately $95 billion in cash. That is equivalence and short-term investment. So its current portion of long-term debt plus long-term debt was approximately $43.2 billion. Microsoft also generated approximately $136 billion in operating cash flow during the last year. So this does not mean Microsoft has no financial risk. It is spending heavily on data centers and AI infrastructure, and future returns on that spending still matters. But the balance sheet number shows that the company had significant financial flexibility. So now imagine another company with $40 billion of debt, very little cash, weak cash flow, and falling sales. The debt number may look familiar, but the risk is completely different. Debt is not automatically bad. Companies borrow money to build factories, acquire businesses, invest in technology, or return money to shareholders. The important question is whether the debt is manageable or not. So if you ask, can operating cash flow cover interest and debt payments? Is debt increasing faster than revenue and profit? Does the company's major debt maturities coming soon? Could the company survive 1 or 2 difficult years without issuing shares at a bad price? Also compare debt within the same industry.